Welcome to XFO Intelligence Podcast. Today, we're examining the global economy at a critical juncture, what I'm calling the Great Reorganization. As we close out 2025, family offices and high-net-worth investors need to understand the profound structural shifts reshaping economic landscapes worldwide. The numbers tell part of the story. We're looking at global growth of 2.1 to 2.4% through January 2026. But these aggregate figures mask something far more significant: the fundamental rewiring of how economic activity flows across regions and sectors. Let me start with what I see as the defining characteristic of our current moment. We're witnessing the decay of traditional economic pathways while new connections form in real time. This isn't just another cyclical downturn or recovery. It's a structural transformation that will define investment opportunities and risks for years to come. The regional picture reveals fascinating divergences. North America maintains relative strength, though momentum has clearly moderated. Consumer spending remains the primary engine, but we're seeing clear signs of fatigue as real wage growth struggles with persistent services inflation. The labor market, while historically healthy, shows unmistakable softening, with corporate hiring freezes becoming commonplace. Europe presents a different story entirely. We're seeing policy-driven stabilization through coordinated industrial investment and energy transition spending. Germany has emerged as a critical connector between Eastern and Western European markets. What's particularly interesting for investors is the surprising resilience in South European economies through tourism recovery and targeted manufacturing investments. But Asia remains the epicenter of this reconfiguration. China's economic rebalancing continues, creating ripple effects across global supply chains. Traditional manufacturing hubs see reduced activity, while new industrial corridors emerge in Southeast Asia and India. Most notably, we're witnessing rapid development of regional supply networks that bypass traditional global trade routes, creating more self-contained but potentially less efficient production ecosystems. For family offices and institutional investors, the sectoral transformation presents both clear opportunities and significant risks. The winners are becoming evident. Clean energy and infrastructure investments continue accelerating, driven by climate imperatives and energy security concerns. Companies aligned with government industrial priorities, semiconductors, electric vehicles, advanced manufacturing, experience robust growth supported by public investment and protective measures. Regional manufacturing hubs positioning themselves as supply chain alternatives attract significant investment, particularly in Mexico, Southeast Asia, and Eastern Europe. These represent compelling opportunities for patient capital with strategic vision. The challenged sectors require careful consideration. Traditional global supply chains face persistent headwinds from trade barriers and reconfiguration costs. Discretionary consumer goods feel pressure from weakening confidence and eroding pandemic-era savings. The technology sector experiences what I call the Great Sorting. Proven applications attract continued investment, while speculative ventures face funding droughts and valuation resets. The critical uncertainty over the next 3 months centers on consumer confidence. Current levels sit in a precarious neutral zone where small shifts could trigger significantly different economic trajectories. The psychology of inflation continues shaping behavior. While headline inflation has moderated, household sensitivity to any reacceleration means central banks have limited margin for error. This brings us to the policy tightrope. The Federal Reserve's expected rate cut exemplifies the delicate balance policymakers attempt, providing sufficient support while maintaining inflation-fighting credibility. However, monetary policy effectiveness appears to be approaching its limits. With policy uncertainty elevated, businesses hesitate to make long-term investments based solely on interest rate signals. For sophisticated investors, understanding networked risks becomes crucial. The global system has developed critical dependencies on certain connector economies, Germany and Singapore being particularly important. The potential failure of any connector could trigger disproportionate disruption. I see three plausible scenarios over the next 3 months. The base case, muddling through with 55% probability, sees continued moderate growth around 2.1 to 2.4%, with consumer confidence stabilizing at current levels and gradual economic reorganization without major disruptions. The upside scenario, soft landing achieved with 25% probability, involves consumer confidence rebounding as inflation moderates quickly, triggering increased spending and business investment. Growth could accelerate to 3.0 to 3.8% as pent-up demand releases and technology productivity improvements materialize. The downside scenario, stagflationary stall with 20% probability, involves confidence breakdown, potentially triggered by geopolitical shock or inflation resurgence. Growth could slow to 0.0 to 1.2% while inflation remains above target, creating challenging policy environments. For family offices and high-net-worth investors, this environment demands strategic recalibration. First, navigate rather than predict. Resilience and adaptability prove more valuable than forecasting precision. Successful organizations quickly reallocate resources as economic pathways shift. Second, monitor connectors, not just aggregates. Traditional indicators may provide late signals. More valuable are measures of economic connectivity, trade relationship vitality, supply chain redundancies, capital flow patterns. Third, build optionality. The premium on strategic flexibility has never been higher. This means preserving liquidity, avoiding overcommitment to single markets or supply routes, developing contingency plans for various economic configurations. Fourth, focus on real economy signals. Financial market indicators have increasingly decoupled from the underlying reality. Attention should focus on shipping volumes, energy consumption patterns, employment quality, rather than relying solely on asset prices. The fundamental conclusion is that we're not returning to pre-2020 economic normal. We're building toward new equilibrium where security, sustainability, and stability factors carry greater weight than pure efficiency considerations. Nations and companies successfully navigating this transition, building diverse economic connections while maintaining flexibility, will emerge stronger. The coming quarter tests whether this new equilibrium can be achieved through gradual adaptation or whether transition will be more disruptive. The outcome depends significantly on whether policymakers can provide sufficient stability for organic reorganization and whether businesses and households can maintain confidence amid uncertainty. For family offices and institutional investors, this represents both the greatest challenge and opportunity of our investment careers. Those who understand and adapt to the Great Reorganization will position themselves advantageously for the next phase of global economic development. Disclaimer: this analysis is provided for informational purposes only and should not be construed as investment advice. The views expressed are based on current economic data and trend analysis, but economic conditions can change rapidly. Past performance does not guarantee future results. Family offices and high-net-worth investors should consult with qualified financial advisors and conduct their own due diligence before making investment decisions. XFO Intelligence Podcast and its contributors assume no responsibility for investment decisions made based on this content. All investments carry risk, including potential loss of principal.